Okay, the Q3 shareholder letter is out October 21st. We're going straight in.
Yeah, no messing around.
We want the core financials, that surprising margin misdecoded, and then what's next? Ads, AI, content. Let's do it.
Right. Let's jump straight to the numbers because,
Mm-hmm.
look, revenue looked okay. Pretty steady, actually.
Mm-hmm.
But the profitability, well, the number they reported immediately stood out. It wasn't what people expected.
No, it wasn't. Top line, like you said, pretty much just forecast. Q3 revenue was $11.51 billion.
Which is solid. 17% growth year over year, both reported and FX neutral.
Right, steady stuff. But then, boom, the operating margin
Yeah.
came in at 28.2%.
And the guidance was 31.5%. That's a significant gap.
Huge gap. That needs a proper explanation, right? Not just a footnote.
Absolutely. And the explanation they gave is, well, it's pretty crucial because it changes how you see their underlying performance in the quarter.
So what was it?
It boils down almost entirely to one thing, a massive one-time charge. We're talking about $619 million.
$619 million. Wow.
Yeah. It's related to this ongoing, quite long-running dispute they have with Brazilian tax authorities, non-income tax stuff.
Okay. $619 million is definitely not pocket change. And you said it hit cost of revenue. Why is that important?
That's super important because when you book something like that, a big regulatory expense under cost revenue.
It looks like your core business suddenly got way more expensive, like content costs exploded.
Exactly. It directly drags down your operating margin calculation. And the impact was huge. That one charge, that $619 million, cut the Q3 operating margin by more than 5 full percentage points.
5 points.
Just from that one item.
Just from that. So the company's line is basically, look, this is technical. It relates to past periods.
Right. They're saying it covers 2022 all the way through Q3 25.
Correct. And they state very clearly that without this specific expense, they would have actually beaten their original 31.5% margin forecast. So they're framing it as operationally strong, just hit by this external historical charge. But I guess the question for you, the listener, is how comfortable are you that another unexpected charge like this won't pop up? Is non-operational just, smoothing things over?
Well, that's the risk assessment, isn't it? Based purely on their Q3 explanation, though, the underlying spending seems controlled. The fallout, of course, hit the bottom line. Diluted EPS was $5.87.
Which was about $1 below what was expected.
Yeah, flows directly from that lower operating income caused by the tax charge. They also said they don't expect it to materially hit future results.
Okay, so if Q3 was, let's say, operationally sound but messy on paper because of this charge, what's the forward look? What's Q4 guidance telling us?
They're expecting that strong revenue growth to keep going.
Yeah.
Projecting 17% growth again for Q4.
Okay.
Or 16% if you strip out currency fluctuations, the FX neutral number. That's probably the cleaner one to look at for underlying momentum.
And the Q4 margin?
Projected at 23.9%.
23.9%. I think the street was maybe hoping for slightly higher, around 24.2%.
Yeah, slightly below some estimates. And that Q3 tax issue, it did ripple through to the full year forecast too.
Right, they had to adjust that down.
They did. Pulled the full year 2025 operating margin forecast down to 29%.
From the 30% before.
Correct. All because of that Brazilian tax charge impacting Q3. But look, while the margin story is complex, the cash generation picture is actually looking, well, pretty great.
Oh, yeah. What's happening with free cash flow?
Big improvement. Q3 FCF was $2.7 billion, and they significantly raised their full year 2025 FCF forecast, now expecting around $9 billion.
$9 billion, up from what, 8.5 before?
Exactly, up from $8 to $8.5 billion. That's a substantial increase in expected cash.
That definitely signals underlying financial health despite the accounting noise. And they're putting that cash to work, right? Share buybacks.
Yep, repurchased 1.5 million shares in Q3. Cost them about $1.9 billion, clearly generating more cash than they need for immediate operations.
Okay, so cash is strong. What's driving that confidence, that revenue growth?
Yeah.
Ads seem to be a big piece of this puzzle now.
A huge piece. They actually called Q3 their best ad sales quarter ever.
Best ever. That's a strong statement. They also mentioned the U.S. upfront, right? Commitments doubled.
More than doubled this year, yeah. And they confirm they're on track to more than double ads revenue overall in 2025.
Which is massive growth, though they do always add that caveat off a relatively small base.
True. It's still scaling, but doubling year over year is still doubling, and they're building the infrastructure to handle it. Big news on the tech side.
What was that?
They're doing a global integration of Amazon's DSP, that's their demand-side platform,
Okay.
and also AJA's DSP, which is big in Japan, rolling that into their own programmatic advertising offering starting this quarter, Q4.
Okay, hold on. For, someone listening who isn't deep in ad tech, what does integrating these DSPs actually mean? Why is that a big deal?
It's all about efficiency and scale really fast. DSPs are basically automated platforms advertisers use to buy ad space across the internet.
Right.
By plugging into major existing DSPs like Amazon's, globally, they instantly make their ad slots, their inventory available to potentially thousands more advertisers worldwide.
Ah, so instead of just their own sales team selling ads, they're opening the doors for automated buying.
Precisely. It lets advertisers use their existing tools and data to buy ads programmatically. It scales the business much, much faster than just relying on direct sales. It's a serious infrastructure move.
Got it. Okay, so ads are scaling fast. Let's pivot from the money side to what actually keeps people subscribed and watching ads, the content. Engagement looks strong.
Really strong. They hit their highest ever quarterly TV view share in their two biggest markets. That's the U.S.
Which saw 15% growth since late 22.
Right, based on Nielsen data. And the UK, even stronger, 22% growth over the same period, using BARB data there.
So what specific shows or movies drove that in Q3?
Well, there were some monsters. Happy Gilmore 2, the return of Adam Sandler in that role.
Huge nostalgia play.
Massive. Pulled in 126 million views. And it apparently set a Nielsen streaming record, 2.9 billion minutes watched in just its opening weekend.
Wow. That shows the power of familiar IP and big stars still.
Definitely. But maybe even more important strategically is the success they had creating new IP.
You're talking about K-pop Demon Hunters.
Exactly. An animated film. It clocked an incredible 325 million views.
325 million. That makes it their most popular film ever, right?
It's the biggest film ever, yes.
Yeah.
But the views are only part of it. The really interesting thing is what they're doing off-platform with it.
The merchandising, the licensing deals.
Nailed it. They announced these huge global co-master toy licensing deals. And get this, with both Mattel and Hasbro.
Both? Usually a studio picks one big toy partner, right? Why Mattel and Hasbro?
That's what makes it so significant. It suggests the IP of the K-pop Demon Hunters world is potentially so big and has so many different facets.
That they need two different giants to handle it all globally.
That seems to be the signal, yeah. Different product lines, maybe different character focuses. It's a massive statement about their ambition to be a true IP creator, like a Disney or a Warner Brothers, not just a streaming platform. It's a big shift.
Okay, that's definitely one to watch. And we can't forget live events either. That seems to be working for bringing in big audiences.
Absolutely. That Terrence Crawford versus Canelo Alvarez boxing match, over 41 million viewers.
41 million.
Made it the most viewed men's championship fight this century. It shows they can aggregate enormous global audiences for these specific appointment viewing moments.
And speaking of big moments, Q4 looks absolutely packed. They're clearly aiming to finish the year strong.
Oh yeah, the slate is loaded. You've got the final season of Stranger Things.
Finally.
The Diplomat Season 3, The Witcher Season 4, and then big movies. Guillermo del Toro's Frankenstein.
Can't wait for that one.
Catherine Bigelow's A House of Dynamite, Ryan Johnson's Knives Out Mystery, Wake Up Dead Man.
That's a killer film lineup. Plus more sports.
Yep. NFL Christmas Day games. Cowboys versus Commanders and Lions versus Vikings. And another big fight. Jake Paul versus Tank Davis. They are really pushing the live event angle.
Okay, so underpinning all this content scale and personalization and the ad business growth too is technology. Let's talk AI. How are they using it?
It seems pretty embedded now, not just an experiment. They talked about using it in sort of two main areas. Improving the experience for you, the member, and helping out the creators.
Okay, member experience first. How?
Primarily refining recommendations, making content discovery better. But the really interesting bit is they're beta testing a conversational search experience.
Conversational search. So like you can talk to the interface, ask it questions to find something instead of just typing keywords.
That seems to be the idea, yeah. Moving beyond just action movies to maybe find me a funny movie like that one I watched last month, but with a female lead, that kind of thing.
Interesting. And on the creator side?
Using generative AI tools to help filmmakers. They specifically mentioned using GenAI and machine learning combined with their eyeline tech for de-aging characters in Happy Gilmore too.
Ah, for flashbacks probably.
Yeah, likely for that opening scene. They also mentioned using GenAI for pre-visualization, basically planning out complex shots for big upcoming projects like Billionaire's Bunker.
So making production potentially faster, maybe cheaper, or just enabling more complex creative visions?
Probably a mix of all three. It's about efficiency and empowerment for the creative teams.
And how does AI plug into that booming ad business we talked about?
It's fundamental there too, especially looking at Q4. They're using AI to test out new ad formats quickly,
Okay.
to generate creative elements that are relevant to the specific viewer and the content they're watching,
Sure.
and even to speed up how media plans are put together for the advertisers.
So making the ads potentially less annoying and more targeted.
That's the goal, alongside making the whole process smoother for advertisers. They mentioned this push as part of accelerating their aim to innovate on, like, dozens of ad formats by 2026.
Okay. Let's wrap up with the competitive picture. They always acknowledge it's tough out there.
Very tough and very broad. They don't just see other streamers as competition. It's linear TV, it's social media like TikTok and Instagram, it's video games, movie theaters.
Basically anything competing for your free time and eyeballs.
Exactly.
Yeah.
Anything competing for share of engagement.
Hmm.
And their strategy to deal with that, it remains pretty consistent. Just focus and continuous improvement.
Meaning keep making better content, improve localization, keep innovating on the tech like AI.
And believe that doing those things well will allow them to keep growing that share of your time globally.
Right. So to sum it up for you listening, Q3's big margin miss looks technical, tied to that one-off Brazilian tax charge. Operationally, things seem strong. Engagement's hitting records, fueled by huge hits and promising new IP. Ads are scaling up fast with new tech integrations, and AI is being woven deeper into both the member experience and the production process.
Yeah, and thinking about this whole deep dive, there's a really interesting tension here, isn't there? You've got this immediate sharp hit to reported profitability, that $619 million tax charge, messing with the Q3 and full year numbers, a sort of backward-looking adjustment.
Right.
But then you've got this massive forward-looking potential signified by something like K-pop Demon Hunters, not just the huge viewership, but those unprecedented licensing deals with both Mattel and Hasbro. That points to a whole new, potentially very high-margin revenue stream from IP and consumer products.
A completely different kind of value creation.
Exactly. So the provocative thought to leave you with is this. Down the road, say 2, 3, 5 years from now, which of these two things we talked about today will have had the bigger, more lasting impact on this company's actual value and its operating margin? Is it the one-time financial cleanup from a regulatory issue? Or is it the successful launch of a new model for creating and monetizing intellectual property globally? That's the really interesting strategic question here.